There are a heck of a lot of misconceptions about pensions. It's their own fault, of course, or the fault, at least, of many of the successive governments and chancellors who've conspired to make them so blooming complicated over the years. I say conspired because I'm sure if you look hard enough on the internet, there's bound to be a conspiracy theory of some kind about it somewhere, probably involving Russians and Liz Truss's deep state. Anyway, pensions of at least the last 20 or so years are pretty straightforward. They are basically savings plans which you can't get your hands on until you're of a certain age, and which, in return for not being able to get your hands on them, give you certain tax breaks or tax reliefs. And I'm prompted to talk about this today because there are a couple of clients we've spoken to in the last week or so for whom those reliefs will be particularly useful. Now, the first is one who runs his own business as a limited company. He and his wife are directors, which is not that unusual. They've been doing what they do for a few years now and are doing pretty well and have built up a bit of cash in the company's business account. Now, they take dividends and salaries and don't want to take any more of that money out and pay tax they feel they don't need to pay at the moment. And here's where pensions come in. Because, well, a pension is effectively the only way you can get money out of a company without paying tax or national insurance or corporation tax. The company makes a contribution to a pension as an employer, and that can be £60,000 or more in each tax year, depending on the circumstances. 25% of that can be taken out of the pension tax-free. Now, again, if those clients are of a certain age, and if they wait until perhaps they actually retire or have lower incomes, the tax on the rest may well be less than the tax they pay now. They haven't actually paid anything into a pension, so can easily justify quite a high level of payments. Now, the other client we've seen has been made redundant. She's actually quite happy about that. She's worked for the same company, same employer for quite a few years, and has therefore had a pretty good, actually six-figure payout. Great, but she's going to have to pay a lot of way in tax. Only the first £30,000 of a redundancy payment or a severance payment is tax-free. So she too can arrange to pay a chunk of that into a pension and claim back some of the high rate tax she's paid. As she hasn't paid the maximum she could into pensions in the last 3 years, we can go back and bump up her payment a bit to perhaps more than the 60,000 annual allowance and saves still more tax. All perfectly legal, quite complicated there because there are some calculations to do, but effectively they're doing what the rules intend, and that's to encourage people to put money aside for their retirement so they don't become a burden on the state in their old age. Perish the thought. So, well, if any of that strikes a chord or rings any bells with you, do give us a call because, yes, I think we could help you.